Good morning once again. My name is Adishan Nadu, and I'm from the Global Markets Retail Investment Team, coming to you live from the trading desk. I have executive with me, Tom Gale, Global Markets Standard Bank Trading. Tom, thanks again. This is the Market Pulse. Good morning.
Good morning, Addy.
Well, Tom, I just want to lay of the land at the moment. We're seeing everything quite green. We see S&P futures up. We see our market currently 0.45% up. We've had previous sessions in the Market Pulse where we've called this a bear bounce. How much of this are we still in a bear bounce, or have we seen the end of that?
Well, look, let's start off by just acknowledging that you're absolutely right to challenge me on this, because yes, indeed, that's right. Your listeners, your audience will recall back in April when the sell-off in the S&P, for example, extended to something close to 20%. And the world felt like a very tough place. And we did say back then, and subsequently, that the bounce, which inevitably comes after a big sell-off, will be what we would call a bear bounce. And we did warn at the time also that a bear bounce has the propensity to be as vicious, as wicked as the sell-off itself, in the sense that lots of people, lots of investors around the world consider the backdrop to be very negative and refuse to join in the bear bounce, the bounce in risk appetite, and then the pain trade becomes that they're missing out and they capitulate back in. So we did call that the S&P could make new highs in this bear bounce. And you're right to challenge me now. What are we? Almost 3 months on.
It's about 2 months on. I mean, it was the 7th of April where we saw that, as you said, the crash that you kind of alluded to now, or that massive sell-off. I wouldn't call it a crash, a massive sell-off. And to your point, there was, as you said in previous pulses, a bear bounce. But I mean, a bear bounce lasting 2 months, 3 months. I mean,
yep.
And you can start calling it the end.
Addy, you can call it a crash because it was a crash because the S&P sold off just short of 20%. That's a crash. Let's be clear. And now you're right to challenge me on the definition of a bear bounce, because as you say, it's endured now for at least 2 months. Is it therefore still a bear bounce? Well, we can all agree it's a bounce, and a bear bounce. The simple answer is we don't know, but I would still argue that this could be still part of a formation, a longer term formation, where markets had a shock of sorts in April, that there's still plentiful liquidity, and that just because you get a bounce doesn't mean to say that it's not part of a longer term formation which could be more negative. We in global markets here, Addy, as you well know, trade a fairly short term horizon. So in the end, we probably don't need to disappear down the rabbit hole of definitions of those formations. We certainly have ridden a long risk position for the last couple of months, and it's been fruitful. The question now then is, names aside, where are we in the cycle for markets? And I will argue here now that we have recouped. We're back at record highs for the S&P. You can see that on the left-hand chart, and bond yields have recovered because there was something of a fear in US Treasuries markets in April too, and those yields have recovered, and credit spreads, which ultimately, let's face it, credit spreads in the US, this is an investor measure of the underlying health of balance sheets of US corporates, and those lines coming lower means that credit spreads have tightened, meaning that there's confidence returning with regards to the underlying health of corporate America. So we've broadly recovered across the board in the US, but this could be now, I would argue, some exuberance that is now crept back into markets. So I'm going to tell you and your audience that we should now be a little bit more cautious. Let's now be more cautious again.
Okay.
The one of the key indicators that we'll continue to watch is, of course, the dollar. It's probably the 2025's biggest surprise has been how weak the dollar has been. Normally, through crises, as we've seen earlier this year, the dollar would demonstrate qualities of being a currency that would benefit from flight to safety. Well, actually, it's been the Swiss franc and others that have demonstrated qualities of flight to safety, not the dollar. The dollar, as our G10 currency strategist Steve Barrow has recently called, is in something of a watery grave. If the dollar's weak, that can itself sustain risk appetite for a while, because typically there's a lot of a cheap dollars. You're not afraid to deploy dollars into risk assets globally.
I just want to touch on that, Tom, as well. It's when you say a cheap dollar, I mean, just for the purpose of this call, I mean, a lot of our clients sit here on online share trading and web trading. It's not a cheap dollar in terms of a dollar rand trade. It's a cheap dollar in general against most of the currencies, right? It's the DXY you're referring to.
Well, that's right, yes, and we use broad terms here, and you're right again to just stop me and ask me what this means. If
a lot of the audience will think dollar rand, dollar weakness. So I just want to clarify.
Well, that's right. So let's just unpack this for a moment. If the dollar is weak, DXY would be one measure. So would BBDXY be another broader measure of the dollar. If the dollar is broadly weak, if it's, dare I say, let's say that it's cheap but it's weak, that means that the currency, the other side of it, is stronger. So maybe we're talking about the rand, maybe we're talking about the euro, and so on. So other currencies have been performing quite well, and so that allows for appetite to be a comfortable appetite for risk in currencies away from the dollar. We're now pricing in cuts by the Fed by the end of 2025, 64 basis points of cuts. So that's at least 2 cuts of 25 that are coming, and that too could allow for the dollar to remain a little bit weak, and for some risk appetite to remain intact. But let's not confuse risk appetite remaining with risks building. So when I talk about there being exuberance in the system, famously it was Alan Greenspan back in the I stand to be corrected here, in the 90s or the early 2000s at least, who talked of irrational exuberance, and this exuberance can hang around for a while. I have no crystal ball, nor do any of us in markets, otherwise we'd be sitting on a beach. How long risk appetite and exuberance can last? But there is increasing risk. Okay, let's deal with some of the risks that are here right on our doorstep as we head into July. End of this week is the deadline, the self-imposed deadline by the Republicans to pass a tax bill, the one big beautiful tax bill that Trump insists Congress should pass. Let's just consider for a moment that it's proposing a big extension of tax cuts, and the addition of more tax cuts, which are not extension, they're new tax cuts, and there will be some cuts to spending, but not as much. Now, what does that mean then? Well, it means, according to the Congressional Budget Office, that it's going to add to the US debt pile. Okay, it's going to add something like $3.3 trillion to the US debt pile. And so wrapped up in this tax bill is also a proposal to increase the US debt ceiling to allow government to continue to be funded with a higher debt carry. Okay, so that's coming this week, and we'll be watching very carefully bond yields to see how the US bond market considers the ability of the US sovereign to continue to ratchet up its debt burden. The following week, we're expecting tariff suspension to be lifted. This was the 90-day tariff suspension. Trump has been pushing for trade deals to be done, and if they're not concluded by then the tariffs will be reimposed. So clearly some deals have been done, for example, with the UK, but even there, and I've mentioned this on a previous pulse, that a 10% tariff baseline remains, and that some sectors sit outside of a trade deal. So, you know, let's take steel as an example. Tariffs remain on US imports of steel, regardless of the country where a deal might be concluded. So we're not going back to a pre-Independence Day, a pre-Liberation Day world in terms of tariffs. And that creates more friction and more costs for global trade. We're also going to be watching carefully upcoming data, US payrolls on Thursday this week, and then CPI the following week will start to show now strain of policy so far this year. I'm not going to go into detail here in this slide, but I do just want to show you and your audience the chart on the left, which according to Congressional Budget Office in the US, partisan independent office, is just warning that the US debt burden is going to surpass what it was in 1946 at the end of the Second World War. So this is historical, what's being added to US debt carry. Also just want to add another warning that we've heard in the last couple of days from the Bank of International Settlements, warning of global turbulence and uncertainty. So I'll spare you the detail here, but just bear in mind the messaging that's coming from global trade groups. And of course, here in South Africa, we've heard once again, we're getting used to once again some turbulence here at home. So I think now we've considered growing risks abroad, we consider the growing risks here in South Africa. Adi, you'll recall that I've always been very positive on the prospects for
a bit gloomy
for South Africa, and broadly speaking, that remains the case. But we cannot continue ad infinitum, ad nauseum, with disputes within the national government and not expect that there won't be a cost to this. So just to recap, the Democratic Alliance's FedEx on Saturday resolved to stay in the GNU, and I think we all broadly expected that would be the case, because the alternative for the DA is this doomsday scenario then of the DA leaving the GNU and EFF or MK being invited in. But the problem for the government of national unity is that the more that there are these disputes which go unresolved and carry a lot of resentment, the more that there are problems of functioning going forward. And one of the problems that has now arisen from the latest dispute around Andrew Whitfield, the gentleman that you're looking at in the picture here, who was removed from his position as Deputy Minister for Trade and Industry, is that the DA has resolved to vote against departmental budgets where the minister, the ANC minister, is accused of corruption. Okay, so the ANC, of course, tit for tat, has now warned they will do the same to DA-run ministries. And how do you function in a government where the government itself is voting against its own departmental budgets? So we're now heading into a very problematic time for the GNU. I'm going to put it here that that this GNU, which we had considered would endure possibly all the way to national elections, I think would all concede. I certainly would argue may struggle to remain intact into local government elections next year, simply because I suspect that the DA and the ANC will want to campaign ferociously on their own from their own podium, from their own position of political ideology. It's very difficult to do it together in government. I think the strains are going to show themselves into local government elections next year. So let's just bear that in mind. The arguing and the repeated arguments around the budget as a good example of tensions within the GNU. It's harming government policy and it's harming economic growth for South Africa. So here I'm sharing slides from our South African economist Elna Moolman, who is showing the extent of downgrades, growth forecast downgrades for so far for this year and for next year. And you can see those numbers in the orange line. So downgrades to forecasts are ending up to be of greater magnitude than a lot of other countries. Those other countries dealing with their own set of problems. So we are now sitting on very anemic growth for this year for South Africa, when actually this should have been a good news story when the GNU came together post-elections last year. And the foreigners that we speak to, the foreign investors, are not going to be wowed by this. So the orange line on the left shows South African growth average from this year through to 2027, and it hardly stacks up well, does it? I mean, there are much more attractive alternatives. Iceland being one of them for average growth for the next 3 years, and of course for any emerging market investor sitting in London, well, they can invest in India or Vietnam or the Philippines or Indonesia. So why would they need to look at SA? So we've got to be very careful now. If we cannot find a reset at the highest level of the GNU, and I'm thinking, a show of fraternity and strength from Cyril and John, resolving to lay to rest all their tensions and disputes. I think that we're now starting to do more damage than good. Rand assets last week lost ground. Currency on the left, bonds on the right. A lot of concern. Now, once again, on Friday, we were sitting here fielding calls from clients and saying the GNU will endure, that the DA will always, for the time being, opt to stay within government because the doomsday scenario is that they leave and MK or EFF steps in. But really, this cannot continue unchecked. And although Rand assets have recovered this morning, it doesn't bode well for the medium term. We are going to get some good news as we go the rest of this year for sure. The removal from the grey list, the FATF grey list, is coming down the road. I mean, possibly as early as October. So there will be some good news stories. But as I said a moment ago, Adi, we are in urgent need of a reset between the DA and the ANC to avoid the constant dispute and conflict becoming a problem. So it's been a good run. It's been a good run for investors, both in SA and globally. And we now just add a note of caution. A note of caution here, please.
Well, Tom, thank you so much. I mean, it's a lot to unpack. It's a lot of controversy, but it's a lot to unpack. It's a lot coming up. And let's just hope our listeners out there are geared for the weeks to come, and with that event risk, as you mentioned, as a big talking point in the next week and a half. So yeah, hopefully they get up, and this call kind of keeps them in the right frame until next week, when you can bring us something. Hopefully it's not as gloomy as you said. You've been very positive, hoping the outlook changes, but we leave that to markets.
Yeah, Adi, just to add, this is not gloom. When we've ridden a big rally, when we've ridden a rally like this, we can all be very, very happy and chuffed. So everything is always relative. What are the prospects from a very high level for equities and tight levels for spreads and for bonds? So that's all I want to caution at this stage. It's not gloom in a vacuum. It's just a note of caution, please.
100%. No, thank you so much, Tom, and yeah, we'll chat again next week.
Thank you.